Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, May 23rd, 2018. This is the second of two videos today. I just put out one covering the broad markets. Decided to wrap that one short of the 15-minute mark since there were, in my opinion, a lot of significant developments worth noting. So if you're watching this one, if you trade the broad markets or have money in the broad markets, I recommend watching that one. They're all, there's not always anything that's really stands out as important. But I think we're at some pretty important levels now, and we could see there's a potential to really put in some more significant developments, especially out on the daily time frame. So again, that was a separate video. This one we're going to start with currencies, gold, precious metals, the miners. Time permitting, I'll run into a few other trade ideas that stand out, such as a couple different commodities, maybe a few individual stocks and bonds if we can get to that. If not, I'll just do the same thing. I'll cut it short, keep it on topic, precious metals, currencies. Now, before I get into this, if you're new to the site, you'll notice that I'll spend more time analyzing the charts of the US dollar and related currencies, the euro, the yen, than I will actually talking about gold. And that is because over time, if you're trying to capture the larger trends, there is a unmistakable, unarguable inverse relationship between the US dollar and gold, meaning inverse relationship, one goes down, the other goes up, and vice versa. This is UDN. This goes back, back to 2013, and UDN is the inverse dollar. I talked about this in the trading room with someone yesterday. If I can show you the dollar index, but the chart's going to look a lot different. In fact, I'll show you that. UUP is the dollar ETF. And let's just type that in for you here and show you what I'm talking about. See this chart, to the trained eye, you can see the inverse correlation. One goes up, the other goes down, but it takes a little more work. You have to look at one inflection point up here, then you have to visually go down, look at the other inflection point down here, where they turned. In other words, gold, by the way, I should have mentioned that. Gold I have in blue here. The dollar index is in black. So by inverting that, UDN is the bearish dollar ETN. It's just the inverse. It shows you the correlation better. And just a quick FYI, if you're new to charting or trading and you're trying to, look to see how what the correlation is between two different securities, and you do one of these overlay charts, don't don't focus on the differential in price. What you want to look at is what direction are they moving at the same time, because the dollar and gold don't move up and down the same in percentage term. Gold will go up more during an uptrend in percentage terms than the dollar will. Currencies don't move nearly as much as commodities in overall percentage terms. Therefore, you get these differentials in price. What you want to look for is a trend. If one's moving down, is the other moving down at the same time? In this case, it was. If one is moving up, is the other moving up? In this case, it was. You can see this very large trend here where they both fell. So that's what I'm referring to as correlation now. And I always say there are periods of temporary disconnects. I can see here that the dollar bottomed, actually the black line, the dollar bottomed. Remember, a peak in UDN, that chart is the dollar upside down. Then the dollar started to fall, and gold actually went on for a while there. I should say the dollar rose. So there are periods, actually, I should clear that error out, of what I call temporary disconnects due to certain market forces. It could be anything, but basically there was more demand for gold. But those disconnects are usually relatively fleeting, and then, this is a long-standing, very clear correlation between the two. In fact, just continued on up, and you can see it there. And it's simple, guys. The logic is simple. When we look at GLD, the gold ETF, you can buy gold in different currencies around the world, but gold, and as far as that ETF GLD, which I'm comparing here, is priced in US dollars. So if the dollar goes down in value, it takes more dollars to buy an ounce of gold. It's very simple. If the dollar goes up, it's going to take fewer dollars to buy an ounce of gold. So that's why this happens. This isn't just voodoo. Same thing happens with crude oil, which is also priced globally around the world. It's priced in U.S. dollars. So let's just look at that real quick. USO is a crude oil ETF or ETN. And if this chart, it just speaks volumes to me. It's there it is. So this is why I'm going to spend some time analyzing the dollar. You can see this is a virtually perfect And again, it's an inverse relationship. I flip the dollar upside down to show you a positive correlation. This is one of the largest disconnects that we've ever had in years between the dollar. In other words, the dollar was UDN. I'm sorry, this is crude oil here. Crude has been rising throughout most of 2018, yet the dollar has been also rallying. Again, it's reflected in a drop in UDN. And normally you do not see that. As you can see, these relationships, for the most part, are usually in lockstep. Then you get these periods of disconnect, and then something gives. You get a reversion to the mean. So I just wanted to make that clear that you're not always going to have this disconnect. But when you go back in time, and you can go back as many years as you like, you'll see a very clear over time trend between, a tight relationship, inverse relationship between the dollar and crude. So now let's talk on the charts of the dollar. Uh, my preferred, one of my preferred, I look at a lot of things, but the euro is by far the largest component. It makes up nearly 60% of the US dollar index. So uh, this euro US dollar pair, it's looking at the dollar upside down again because it's showing you the euro against the dollar. And so when this is falling, the euro's rallying, the dollar is rising. Now, I keep pointing this out. We had divergence right here. I pointed out the other day. We popped this. We've made a lower low here. This is a 60-minute chart. Guys, if I don't make mention, I know I talk fast, move fast. My time frames are always up here right in the corner. So this is an hourly or 60-minute chart. Divergent low. It did play out for a rally, but not the trend change I'm looking for, which I still strongly believe is coming. One guarantee that I only give in trading and investing and on this site is I will be wrong at times, but I'm going to tell you when I have a strong opinion, and now my opinion's strong, that a major reversal is coming in the dollar. So do what you want. There's another divergent low. We're starting to turn up on the momentum indicators, and you'll see gold begin to rally. And gold's actually kind of holding its own lately. The euro keeps or the dollar keeps moving higher, euro falling lower, and gold seems to have found its bottom, especially the miners, and that's the proxy. Remember, we're not gold's not an official trade. I'm not trading. Actually, I'll take that back. I do have gold. I have a contract of gold futures, but I'm also trading the miners. That's my preferred proxy on trading gold. So I have in various accounts gold mining stocks, and they've been holding up, and that is a good sign. It tells me that those in the know, or for whatever reason, that gold GDX is anticipating a turn, or at least not buying into this recent move down in gold. There it is, guys. That to me stands out. This was a divergent low right here. We had a nice rally in the euro. That means the dollar fell. If we rally again in the euro US dollar pair, that will mean dollar falls, and these are all potential targets. And then more importantly, we go out to the daily time frame, and this correction in the euro US dollar was seen coming. I was pointing it out way back here. We had this rising wedge, we had a divergent high here, we had a correction, we hit both my targets. I had a T1 and a final target, hit that, reversed, went up, made a second divergent high, big powerful divergent high, and there's a correction in the euro US dollar. So it means the dollar rallied as the euro fell, and now we're at support. You can see right here, it's a good support level. I really like this support. I mentioned this support zone. I thought we'd bounce. We did bounce there, but that wasn't the stopping point, at least not yet. But there's a lot of reactions. I'm circling those with the purple box along this level right here. So we have bullish divergence right here, positive divergence as the euro is oversold. In fact, this is the most oversold the euro US dollar pair has been in at least 2 years, probably a lot longer when we go back. So oversold at support with bullish divergence. In my book, it doesn't get much better than that. Does that guarantee that we can't drop down to this next support zone? Probably bring that line up a little higher. No, anything's possible, but the odds I think are strongly in favor in the coming weeks to most likely the coming months a counter trend rally, a pop in the euro, meaning the dollar falls as euro rises, which in turn is bullish for gold. Before we get off currencies, I told you I was going to talk a lot about currencies. The second largest currency in the US dollar index is the Japanese yen. This chart speaks volumes to me as well. 13.6% weighting in the dollar index. As I put up this chart yesterday, probably shouldn't go into too much detail because this was posted on the front page. Just by just going off overbought readings, that's all these white arrows down below on the RSI at the bottom here. Here, let's pull that up for you guys. just by looking at each of those overbought readings, if you went short the dollar against the yen. That's the US dollar versus the yen. This time the dollar's first. That means when this chart's rising, the dollar's rising against the yen, unlike that euro chart, because we had euro first and the dollar last. There it is, oversold. Again, I didn't skip any of that. Well, that one actually, I have to be honest, I guess I missed that. That one fell a little shy of overbought, I should say, not oversold. But every other arrow here, oversold, correction, oversold, correction. I mean, that marked the top. Um, in a big correction there. Oversold, oversold, oversold. Why do I keep saying oversold? Guys, I mean to say overbought. I'm sorry. Overbought. It actually didn't end until we were all the way down here. And again, I could make the case for oversold, which I keep saying this is oversold down at the bottom. But there it is. So right now, fast forward, we are not just overbought right here with that white arrow, but we had a two consecutive overbought readings back to back with the indicators making higher highs. So we have overbought plus a divergent high. The last time we were overbought with a divergent high was right here, and that was the biggest drop that the yen had or the dollar had against the yen in a long time. So we've broken down. There's a pretty well-defined uptrend line right here. You can see it's starting to crack right here on the yen. Everything I see says that the dollar is going down in the coming weeks to months here. There it is. And if I'm wrong, it won't be the first time, but a lot of my positioning hinges on that, bullish gold, the mining stocks, especially platinum, things that I've covered. This was a 60-minute chart. You can see here, very clean ascending price channel on the US dollar yen pair, breakdown back test, boom, TA is working good. This was support. We smashed right through that support, but remember, support once broken becomes resistance. It's a well-defined level too. Look at all these reactions to the left, right here, reaction, reaction, reaction from above. We smashed down through it. So this former support is now resistance, and so that's what I'm looking for. Let's see if the yen or the dollar resumes its downtrend against the yen. Lots of time spent on the currency, as I told you. I won't speak too much on gold. We are close to oversold on gold. Last time we were oversold was right here. You see that white arrow? That's what happened. Boom, big rally. We were oversold here. Again, just replicate this on your chart. You can go ahead, look at all these oversold readings or near oversold, and look what happened to gold afterwards. So, trading is all about putting the odds in your favor. That's why I don't make any guarantees to anything. I know sometimes these things don't play out, but you want to start getting bullish on gold, especially during a primary uptrend, which this is since the 2016 lows. No one can argue that. Gold has been making a series of higher lows and higher highs. This is an uptrend. Therefore, in a bull market, which gold has been in since late 2016, you want to buy pullbacks to support, especially when you're oversold, because during a bullish trend, oversold readings are typically very fleeting. You either hit that level, the 30 level, the blue line, and then reverse, or if you go through it, you don't stay there long. In a bear market, and remember, this was at the tail end, this was the end of the bear market, so oversold became more oversold, went below the 30 level, or stayed oversold for an extended period of time, but that marked the bottom. Since then, we've been in a bullish trend. And the same thing happens in reverse. Oversold tends to become more oversold or stay oversold for an extended period of time. Overbought. Gosh, I keep mixing those terms up. Please, guys, I think you know what I'm saying. If you don't, I'm sorry, I'm trying to talk fast here. So here's overbought when you're above 70, oversold when you're down on 30. We're oversold in a bull market in gold um, at support to boot. I mean, here's a weekly chart. I pointed this out recently. It's a big triangle. Now we need to take that downtrend line out. We need to especially take that 130.05-ish level out. That's pretty significant resistance. But here we are. We're at support. You can see one, two, almost three. There's a definite third, and now a fourth reaction here. If we get a reaction trend indicator, the PPO is above the zero line. So that's what I'm looking for. Reversal here. If we break that level, particularly on a solid weekly close below it, that's not going to be really good. Could take gold all the way down here to 115. So, I have to keep all options open. But by all accounts, I haven't seen such a good setup in gold in a while. I think it might require a little patience, and then finally to just wrap up. And I won't go over each and every individual gold mining stock, but there's GDX. Excuse me. Uh, Stop is still intact right here. Stop at 2190. or was it any move under 2190? Either way, we took out this trend line, but GDX has been resilient despite the strength in the dollar and the weakness in gold. It's been kind of holding its own here. So that's that. It's up today again, despite gold being down. It just shows you that these miners, they don't, they're not buying into this pullback in or this correction, this drop, or that breakout of that support zone in gold. All right, enough on that. Of course, do what you want, but I like that trade, and I might even give my GDX position some more room if they take out that official stop. Platinum, talked on this one recently. It's a great, one of my favorites of the precious metals right now. This level here, support, this orange line right there at 85.15. PPLT, by the way, is what we're looking at. That's my preferred proxy if I'm using an ETF to trade platinum. So you can either use platinum. You can use platinum futures or PPLT if you're an ETF trader. Holds physical platinum. And again, just a super well-defined support level. This was a bear trap, a false breakdown, but it happened on a divergent low, so that would have told you don't don't be the sucker that shorts a breakdown of support when you have bullish divergence. That doesn't mean that couldn't have played out, but I don't short breakouts to new highs when they're divergent highs, nor do I buy breakdowns of support when they have bullish divergence. And so what happened there is those that shorted that well-defined support level, the shorts got roasted and they got ramped. And this is what happens. Fewer things in trading are more bullish than a failed breakdown because of that reason. You get the shorts that pile in, oh, support's broken, let's short platinum. And then they get squeezed out once they see that breakdown didn't pan out, that it turned out to be a bear trap. They start to cover. And then you get the natural buyers that see it moving up and they know, and they've got you on the ropes. They have the bears on the ropes. They start buying. And, the bears didn't have an opportunity. A short did not have a single opportunity, an objective opportunity. If they shorted there to exit, you can see there was one red candle and it was about flat. Every one was a green candle. So there wasn't a big down day where they got another back test of that level or anything even close to their entry price. In fact, there was a big gap to just leave them behind. And that's what I love to see in trading. So what happened recently? We had another failed breakdown of that level. Big bullish green candle. But as I mentioned, there's some work to be done. There's a down trend line we have to take out. There's a horizontal price resistance. That's where we stopped cold. I had that level before we even went there, 86.51. That needs to go 86.51, and more importantly, this downtrend line. And then you can see these are my next targets. So that's where I think platinum's going. We're 17 minutes into this video. Let me see if I want to wrap it up here, cover anything else. Yeah, I'll wrap it up here. I was gonna cover crude oil since it's a dollar sensitive asset. Although not recently, it seems to be marching to its own drumbeat. But we'll cover that in another one because that's a commodity. So I'll cover that. There's a couple other commodities I want to cover. They're not as dollar sensitive as crude, but I'll wrap that up in the next video. We'll keep this one here at the 18-minute mark. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.